Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Whilst I just let you have a look at the disclaimer quickly, I'll just run through what we hope to get through in the next 30 minutes or so. We'll follow the normal format, so we'll just check out how markets are trading currently. We'll look at obviously the big current theme actually at the moment, obviously all around the Alaska summit and what happens there. We've got a chart on that from Poly Markets. And then we'll look at equities, how they finished last week, and a little bit of sector performance before also looking at some of the major US indices, the stock indices, the charts, and some technicals around those. Then we get into last week's main events, which were obviously the US CPI data. We'll look at that and a few charts actually. The RBA meeting as well, where they cut rates as expected. So we'll look at Aussie dollar. And then there were some UK data points as well. So we'll look at that and look ahead to the UK CPI figures. So we'll look at cables. So that's sterling against the dollar. Before then, focusing on this week's big highlight, which will, of course, be the Jackson Hole Symposium, the Fed's Jackson Hole Symposium, and Fed Chair Powell's speech, which is on Friday. So we'll just go through a few thoughts on that. Look at the DXY index, which is the dollar index, and as well, hopefully, we'll look at the RBNZ meeting. So we'll look at Kiwi against the dollar. And we also have some PMI data actually. So we've got a good matrix from Reuters. They produce a really good matrix around the PMI data and look at euro dollar as well. So various different areas to look at, focus on this week. If you do have any questions, I should say, please do please do ask them along the way, and we'll try and answer those as best we can if you put them in the chat. Just anything we're talking about, of course, or anything you're looking at. Yeah, any questions, please do ask them along the way. Okay, here's what we've got lined up. As I said, markets currently, well, interestingly, actually, after the summit, of course, on Friday, a lot of media reports being quite negative about it. No concessions, no ceasefire, of course, but markets far more sanguine, really, and less critical about those media reports in a way. APAC stocks, Asian stocks, they began the week mostly higher, actually, following the summit then. And Europe actually started firmer before now. Most European indices are in the red. US futures, just looking at those, equity futures marginally now in the red, actually. They pulled back, actually, from sort of bigger losses that we did see just a couple of hours ago. Just the dollar was initially steady ahead of course, Jackson Hole later in the week. Found a bid actually and just pulled back slightly as US traders come to their desks as well. Yen, I'm just looking at that, has been a bit of a laggard today, nothing too major. And Kiwi dollar actually, the Kiwi is doing probably the best of all major currencies. Crude futures, that's a gauge for sure for this Alaska summit, really, and what happens in Ukraine. Were slightly bid, but now slightly off actually in the red. So little change really after that meeting. And gold is just pulled back from some gains that we saw earlier this morning. Two-way price action before that, but now slightly bid up around 3,347. So yeah, obvious focus on the Alaska summit on Friday. I've got this poly market chart just before I get to that. Obviously, the summit where President Trump and Putin met to discuss the war in Ukraine. Talks ended earlier than expected. Actually, were unsuccessful in making any imminent progress towards a ceasefire. As I've said, no ceasefire, no real concessions. One positive, though, was news of Stephen Witkoff, who is President Trump's special envoy to the Middle East. He said that Putin had agreed that the US could provide security guarantees to Ukraine as part of a deal. And that has been central for Ukraine, central for European partners as well, to any path towards peace. So that was or is potentially a positive sign. But then if that's tied to territorial concessions, that is a big red line for Ukraine for sure. So difficulties obviously lie ahead, and you can just see on this chart poly markets is basically betting markets which have gone pretty big in the US now, and you can just see this pickup really in the blue line being a ceasefire possibility, was obviously down around 20% for this year, picked up but just sort of around 30% now, and then ceding territory. Interesting, just above that sort of ceasefire line, but still pretty low in the context of where we have been in previous months. Any clarity, of course, then going forward on this territorial concession versus then the ceasefire will be important. We do, of course, have the meeting now between President Trump and Ukrainian President Zelensky, plus other European leaders from the UK, Germany, France, I think. President Trump actually after the summit, just to confirm, he decided to hold back as well on further sanctions against Russia, as well as also those secondary tariffs that we've seen on countries buying Russian energy, such as India and China. So he's pulled back on those as well. For asset wise or just market wise, is what we're watching. We'll be watching oil, as I've mentioned. And then the euro, of course, euro Swiss as well, always a very good indicator of risk on, risk off, really, especially to do with the Ukraine. So just watching that, and at the moment, very quiet, really, for those indicators. Kind of seems sequencing is critical, really. You kind of think Ukraine needs a goodwill gesture from Russia first, really, while then Russia will only do this once, of course, it's had Ukrainian approval in principle for ceding territory. So that's kind of thoughts on that and where we go next, really. Tough situation, and all eyes on the Trump-Zelensky meeting, of course, especially after that one that we saw a few months ago in the White House, which wasn't great. Great optics, really, for Zelensky. Moving on from that, then, otherwise equities. I'll just pull up a couple of charts first of all. We just got the S&P 500 here, but equities last week, well, ended on a moderately soft note, really. Broader picture remains, though, another week of gains. Of course, under the surface, as I said, cyclicals, interestingly, they underperformed defensives. Tech basically underperforming defensives, and the Dow really outperformed in a way. The real story was a sort of sector rotation. So we saw a particularly strong comeback in healthcare, actually. And that has, well, last week investors finally rotated back in, really. Healthcare gained nearly 4% in Europe, 5%, more than 5% actually in the US. So that outperformed staples by 4% in relative terms. So really then it wasn't a broad defensive theme, because otherwise you would have seen staples outperforming as well, but a clear rotation story, kind of reflecting easing tariff fears in healthcare, and then obviously the sector's prior underperformance that we've seen. So just little nuances there with some of the sectors in the US last week. So we saw the S&P down on Friday, down 0.3%, Nasdaq down 0.4%, whereas the Dow finished up 0.1%, for example. Asian equities, as I said, higher this morning. Futures in the US pretty flat, very marginally in the red. So chart-wise, I mean, I can't say too much more. We're on record highs and seem to be going higher, really. You could just see a turn down in the RSI, so that's bullish momentum after that down day on Friday. And we are sort of just at the bottom of this ascending bull channel, really, that you can see. We've traded up and along for the last few sessions, really, since that low at the start of August. Similarly with the Nasdaq, could have a bull channel in there. And we just sort of come off that high from last Wednesday, just below 24,000, so it didn't quite break that round number. And you've got the previous high from end of July at 23,573, possibly initial support. The blue line there is the 50-day moving average. That's below, well below 23,000, 22,744. With that August low at 22,972, just above that. The Dow then, as I said, did better last week, made new highs, although it did pull back on the close, but still finished marginally higher. On the day, did break 45,000, 45,200 through the high now, but we closed below 45,000. So interesting. That was the previous high, actually just above 45,000. You see it there, 45,054. So whether that is a level of support, you've got the 50-day much lower down below 44,000 and 43,884. Okay, let's move on now to last week's main events and US CPI first up. Really important economic release, of course, as we know. Fed's dual mandate is price stability, of course, and then maximum employment. So, yeah, CPI figures actually came in largely as expected. So, headline that rose 0.2% month on month, 2.7 year on year, actually below the 2.8 estimate, and core rose 0.3% month on month. 3.1% year on year. That was a one-tenth hotter for both month on month and year on year. Details, just for your guide, this chart actually obviously was just before the print, so you can just see relative to what we had seen. And details when energy prices fell 1.1% month on month, while food was flat on the month. And in terms of sectors most exposed to tariffs, which is obviously key for markets, things look again fairly benign for another report. Really, we had that previously. Focus was on core goods ex autos, so they rose 0.2% month on month after jumping 0.6% in June. So kind of suggests that for now, at least, corporates are absorbing most of this tariff cost, not passing on to consumers, of course. Fed Chair Powell, he started to look at super core, just for your guide. So that's core services minus shelter. And that rose to 3.2% actually from 2.7%. And I've just got a chart with one of those core goods ex autos. You could just see that big 0.5 month on month, 0.6, sorry, 0.55 it actually was month on month. And then that pulling back to sort of 0.2, even though the year on year number is going higher. Going forward, you've got ISM price components. They still suggest there may be a lingering inflation threat from tariffs, but we did have a survey, NFIB survey, small businesses essentially suggesting they are struggling to pass those costs on to consumers. Most economists, I should say, think that many prices will end up rising in time due to tariffs. But possibly then, and as I've mentioned this many times in these webinars, economists have sort of flipped from seeing inflationary pressures longer lasting now to sort of one-off price impact. So they don't now see inflation pressures persisting. So there's just that shift, which I kind of find interesting. And all against that on the CPI data anyway, you've got cooling housing rents, cooling wages and cooling energy costs potentially, all expected to offset then the tariff effects over the coming quarters. So even if we do get tariff inflation impact that we see in the coming months, then we've got those offsetting factors as well to consider. I guess you also need to think about, or we're thinking about consensus GDP forecasts as well. They've been cut, if you think about it, from 2.5% at the start of this year down to sort of 1.5%. And potentially then, of course, that affects wages and those other areas that we've talked about, potentially offsetting any tariff-induced inflation impact again. I will mention it for the Jackson Hole symposium, but of course we get one more CPI report, US CPI report, that is on September 11th. Actually, that's just a week before then the September FOMC meeting. And regarding sort of PCE implications, so the core PCE number is the Fed's favorite inflation gauge that comes out, that data at the end of this month. And economists reckon the CPI figures that we've just gone over are consistent with a sort of 0.23 increase month on month in the core PCE. So nothing again too alarming for the Fed at this time. That was a sort of key takeaway really at the moment. And of course, will have an impact on policymakers going forward. As I say, though, there is one more CPI report before the next Fed meeting. We did have July retail sales figures out end of last week as well. They came in strong, actually 0.5% print for the headline, while the June numbers were revised up actually from 0.6% to 0.9%. The control group sales, that's the core group, impacting GDP really, they came in at 0.5% as well, month on month. And basically, there were solid sales reported among most sectors. Interesting numbers again, and sort of just sort of impacted then Fed rate cut bets slightly, which we'll get to shortly. That's US CPI data. If we now just go to the RBA meeting, we'll sort of get onto the Fed later on when we look at Jackson Hole, of course. But just last week, whilst covering those events, the RBA, of course, that meeting. I'll just pull up this chart, which is basically money markets implied rates for the each RBA meeting going forward, essentially, and those odds haven't changed a great deal over the last month and even after the meeting. So the RBA did lower the key policy rate by 25 basis points to 3.6% as expected. That brings cumulative easing to 75 basis points now for this year. Inflation, they said, continued to moderate, with updated staff forecasts suggesting that underlying inflation will continue to hover around the midpoint of the 2 to 3% target range, basically assuming an extension of the current gradual easing path that you can see here. The RBA they judge that there's still a risk of households and firms delaying expenditure pending greater clarity on the outlook, which is of course key. And of course, even though the worst trade outcomes really have actually been avoided. Markets, they basically interpreted the downward revisions that we saw to inflation and growth forecasts as a mildly dovish signal, but then Governor Bullock actually kept forward guidance open-ended and data dependent. Essentially, there's caution around the outlook, heightened level of uncertainty, all to be expected really, and they'll do what is necessary to achieve their dual mandated price stability and maximum employment as well. Money markets in Australia, then they assume 2 more rate cuts really at a sort of quarterly pace, and that will bring this policy rate down to around 3%, 3.1%, around that figure for the terminal rate by probably it's probably by March, February 2026, around that figure, where there are 2 rate cuts priced in up until that point. As I say, pretty negligible reaction actually after the RBA. Really, the rate cut was fully discounted, of course, and kind of limited changes all into the RBA statements. And as I say, this curve didn't really move too much. If we look at the Aussie dollar, though, is obviously impacted by the broader risk mood and sentiment. Let's just pull up that chart. You can see here, just bear with me 1 second. Yeah, you can see it here, just checking you can. It hasn't really gone anywhere really, kind of range trading really between kind of 63.50 and 66 at the moment. In amongst that, of course, you've got the blue line, the 50-day moving average, 65.18, kind of pivot point really, 66 just above there, 66.25, that recent high, and then support around the halfway point of this move lower, which is at 64.27. You can see it cap the downside there, end of July, and then the start of August. So that should be decent support again. The black line, just for you guys, the 200-day moving average, that's at 63.86. Also, I should say we had, bear with me 1 second. We did have some UK data actually, which was UK GDP actually beat expectations, 0.3% in Q2 after a strong 0.7% result in Q1, probably down to public demand. Actually, household consumption was low, investment down, but government spending actually was higher, so that helped GDP. We had labour market data as well, shown tentative signs of improvement. Actually, unemployment rate held at 4.7. Employment growth accelerated though to a 9-month high, and that kind of suggests the kind of flow of new entrants into the labour force in response to a robust labour demand, really. Wage growth then probably going to maintain a robust pace, and that is an issue for the Bank of England or markets if they're wanting rate cuts. Just moving on actually from that data last week then to we do get UK CPI data, as I mentioned. Here, moving on from last week's main event, just before we get to Jackson Hole, UK CPI. Headline inflation is expected to tick up modestly, actually, as food and fuel prices have risen. A 4% peak is then seen in September by many economists. That is a crucial number. And the all-important services metric then is forecast to increase as well and could actually exceed the most recent Bank of England projections. And that, as I say, is an issue for the MPC going forward. That gives them a headache. And I know some economists argue that it may then impact on the Bank of England sticking to its quarterly pace of rate cuts that we've seen, particularly, of course, given the hawkish level of dissent actually that we saw in the last meeting in August, just a few weeks ago, of course, on account of inflationary developments. Obviously, you had that split, if you remember, and the second vote as well, which I think was the first time or hasn't happened in many, many years. That very much a split between rate cuts for people on the MPC voting for that, one voting for a 50 basis point cut, and then four voting for no cut at all. So they had to have a revote, of course. Market pricing at the moment concurs with that hawkish view. The next 25 basis point cut for sterling, sterling interest rates, base rate not now priced in till next year, sort of February, March time. If we just look at cable actually, and let me just pull up that chart. Has been strong, of course, because the dollar has been weaker, and we've had then those Bank of England rate cuts priced out and reined in, of course, after that more hawkish Bank of England cut, if you like, and some of this data that we've just gone over. So cable doing relatively quite well, consecutive days of gains you can see there, and sort of had this mini descending bear channel, but we've broken out of that really, broken above the 50-day moving average, that blue line, which has been support, although it was broken, of course. So possibly watch out for that as initial support. Just looks like potential bullish flag before a break higher. So top side 135.94, the level to break from last week if we want to get towards 137.84, that multi-year high. Initial support possibly at the 50-day moving average. That's the blue line at 134.98. And then below that, you've got this long-term high we still kept in there from September of last year. That's a 134.34, and then a fib level just below that, 133.86. Okay, getting on to Jackson Hole then, and this week's highlights really. RBNZ meeting, as I said, and also PMIs we'll get on to, but Jackson Hole, that's the annual symposium, annual conference basically, of which the Fed, Kansas City Fed, puts on in Wyoming, in Jackson Hole, essentially. And Fed Chair Powell is due to speak on Friday. The symposium kicks off on Thursday to Saturday, but his speech will be on Friday. And yeah, this sort of confab really has been historically used by Fed speakers to signal upcoming monetary policy changes, although it kind of hasn't always held true in more recent years. Data-wise, if you think about it, then recent data in the US probably suggests it's too early for the Fed chair to kind of unequivocally open the door for aggressive further monetary policy normalization just yet. Since the downbeat jobs report, of course, at the start of the month, non-farm payrolls, of course, those big revisions, markets have started, aggressively to price in that September rate cut. I think there's now around a 85% chance of a 25 basis point move. We did then get the most recent CPI data, as we've just gone through. was not as hot really as feared, bottom line. So sort of further bolstered rate cut bets. But the PPI data then we got the following day was much hotter than expected. So we saw some dovish unwinding, although not that much for the September cut. As I've said, 85% chance of that happening, according to money markets, pretty much at the moment. Fed speakers, Fed officials, they've been in blackout, of course, but several have alluded to a 25 basis point cut in September, but then others have appeared more reluctant as well, and certainly not in tune with, for example, Treasury Secretary Bessent, who recently urged the Fed to begin a rate cut cycle with a 50 basis point reduction in September. So yes, markets will continue to be looking for any signs that the Fed is giving more weight to possibly that labour market softness that we saw rather than potential tariff-driven inflation. If that does happen, it may be too early for Powell then to all but confirm a Fed move in September. Markets price for that, but it will be interesting whether he does push back against rate cut expectations. Again, there is one more CPI report, as we mentioned, before the Fed meeting, and also actually one more non-farm payrolls report, of course, on the first Friday of September. Then you get the following CPI report the following week, and then the week after that is then the FOMC meeting on the Wednesday. Really interesting Jackson Hole speech then potentially coming up. Whether Powell sticks to sort of data dependent meeting kind of idea, or perhaps only when the facts of a solid labour market change, which is what he called the jobs market just before that non-farm payroll report, actually, will he then acknowledge potentially a change, of course, in, as I said, the labour market. Kind of think as well, and we've written about this before, that many Fed officials, Powell as well, will be careful of any missteps, of course, post-COVID and that transitory call that they had around super high inflation. And you kind of think they will be conscious of not then cutting too early this time around. We do get other Fed speakers at Jackson Hole as well, so they'll give their views on policy and the economic outlook, and really explain their thoughts on the recent non-farm payroll and inflation data too. So watch out for those on the wires. Otherwise, we do get FOMC minutes on Wednesday. Markets kind of on watch for any signs rate cuts are incoming, of course, even though Powell kind of leaned hawkish in that press conference afterwards. And at that point, it pushed against the September rate move. Things have moved on since then, but yes, markets may look at that briefly, although the speech on Friday by Chair Powell will be, of course, of far more significance. If we pull up now the dollar chart, so bear with me 1 second, which is here. So you can just see we're just consolidating just below the blue line, which is the 50-day moving average, again, 98.08 that is, and you can see it sort of worked as resistance on a number of occasions this year already. Obviously, we broke above it, but we couldn't break sort of 99.57, which is a long-term low from July 2023. That tallies with this fib level as well at 99.63. So we tried to get above it, but then collapsed on that non-farm payroll report, of course, and then we just sort of been edging lower, and now we're just sort of trading around, as I said, that blue line, the 50-day moving average. Last week's low then is at 97.62. If we break that, then we've got these lows from late July at 97.10, before then a long-term low from the start of July at 96.37. Dotted line, just for your guide, is a very long-term support line from these lows in 2011 and 2021. So you can just see that, which comes in just more or less around that long-term low, just a bit higher actually now, around sort of 96.61, just for your guide. Obviously, if Powell pushes back against rate cut bets, then you should probably expect some support in the dollar. We should push above there although that resistance level of zone around 99.57, 99.63 is looks fairly decent at the moment. Otherwise, yeah, moving on from Jackson Hole, then we do have the RBNZ meeting. Just pulled up the Kiwi dollar chart here. RBNZ, they're expected to cut the OCR rate, the overnight cash rate, by 25 basis points to 3%. Policymakers, well, they paused in July as expected. That was after a prior streak of 6 straight rate cuts. The minutes from that meeting actually revealed the committee expects to lower the OCR further, broadly consistent with the projections outlined in May, and that the case for keeping rates on hold at the July meeting highlighted basically again elevated uncertainty and the benefits of waiting until August, considering near-term inflation risks. Rhetoric from the central bank since kind of has continued to highlight trade-related uncertainty. Levies will mean a weaker global economy and a weaker and also weaker global demand. Since the meeting, inflation has been softer than expected, though relatively contained. Actually, we've seen a small contraction in jobs growth during Q2. With a modest uptick in the unemployment rate. Expectations really are for then the RBNZ to maintain a data-dependent, cautious stance. So any shifts, of course, from that will move the Kiwi. Obviously, Kiwi moves on external events a lot. Yes, that's why they stressed, of course, potential weaker global economy, weaker global demand going forward. On the chart, you can just see we're trading around the halfway point of this move lower, which is at 59.31 there. 50-day moving average just capped the upside there. That's at 59.88, and then you've got highs, multi-month highs from the start of July at 61.20. Below, you've got that swing low from the start of August, this month's low at 58.65, and then you've got the next fib level, 58.25. And the 200-day moving average at 58.34. Okay, just quickly then, we'll look at the PMI data as well, which is here. I said there was a really good matrix from Reuters, which you can see here. So PMI data, basically business surveys, which can show essentially economic trends months before they appear in the official data. And potentially they'll offer this data clues about whether US tariffs are driving possibly the world's biggest economies towards sort of stagflation, so slower growth and higher inflation, or actually possibly the other way, or not the other way, but ignoring sort of higher prices, where the growth momentum is still continuing. You can just see blue means numbers above 50, which is in expansionary territory. And then obviously red numbers are below 50, which is contractionary territory. So yeah, just sort of nice matrix, warm and cold matrix, really. Well, not warm and cold, sorry, blue and red, I should say, with the different PMIs that we have seen across the last year or so. Just for Eurozone manufacturing PMI, that's a big one that most people focus on, traders. Manufacturing, that's forecast just below 50 at 49.5 from 49.8. Services affected above 50, just at 50.7, previously 51. Then the composite is basically at 50.6 projected, previous 50.9. That 50.9, well, it matched an 11-month high in July, actually, despite a sort of marginal downward revision in the final release. However, the rate of growth remained modest, just above 50, and could see some softening of growth momentum if we look at declines in, the Centix survey and also the German ZEW business survey. Kind of contrasts with the IFO, which was mixed but slightly more positive than that ZEW survey. So, yeah, those are PMI data for the Eurozone especially, which is always a big focus. Finally, if we just pull up the euro-dollar chart, which is here, just see, again, blue line, 50-day moving average, looks like decent support. Potentially that's at 116.35. You've got the high from, multi-year high really from the start of July, again at 118.30. So if we do break last week's high at 117.30, then probably going up towards at least these highs, mid sort of late 117s, and then obviously that high just above 118. Otherwise, support, yeah, blue line initially 116.35, the 50-day moving average, and then you've got the first fib level actually not down, not quite some way below actually, around 114.39. That minor fib level of this move higher. Okay, I'm just checking if we have any questions. We don't have any questions, so hopefully that's been really clear to you guys. Please do follow us on social media, and also I always say we put out a daily commentary on the website after the US close. Every day has a look at the dollar, US indices, a look at the day ahead, and also a chart of the day. So yeah, please do follow us, and also you can read that on the website. Yeah, lots happening at the moment, geopolitical issues, concerns, of course, and also then Fed implications from Jackson Hole at the end of the week. Take care out there, and we will see you same time next week.